Sanat Rao, welcome to the show.
Thanks for having me, Jen.
Thanks for being here. Now, I just want to highlight something. The value of IRL conferences. You and I actually met on the plane into Korea, and now you're sitting here at the desk. I want to say, if you sent me a message on LinkedIn, I might have just ignored it for a year or something.
So, it is incredible.
It's good to be cooped up for 15 hours together on a flight.
So you can meet your colleagues in the industry.
Sometimes things were just meant to happen.
Yeah. Exactly. All right, you are on a panel. I believe it's happening right after this interview. It's called Making Sense of Macro. Talk to me about the major macro trends you're watching in this region and outside of it.
Yeah, so just as a background, Monarq Asset Management, we are a classic multi-strategy investment manager in the crypto space. And I run the DeFi strategies at Monarq. And so everything I look at is from the lens of DeFi and yield. And so one of the things that really impacts DeFi at the macro level is the Fed monetary policy, right? And it is interesting. So the Fed, as we all know, Fed dropped interest rates. They cut interest rates by 25 bips last week. What that does is, it's very interesting about the impact in DeFi. There's two impacts. One is that when the Fed cuts interest rates, the risk-free rate in public markets goes down, which then makes the rate in DeFi more valuable, right? So today you can earn 4 to 6% on Aave and Morpho, and that's great. But when the T-bill rate goes down into the 3.5%, this becomes a lot more interesting. The second thing that happens when the Fed cuts rates is that it becomes a risk on, right? There's a lot more money in the market. People take more risks. They're coming into DeFi. They're levering up on perps, and all that again causes the yields to go up. So for us, if I had to say, the single biggest factor that impacts DeFi yields is the Fed monetary policy. That's what we've been looking at.
And when you think of macro, I feel like yield is what so many people talk about. And do you see a future where TradFi has to start figuring out how to match the yields of DeFi?
Yeah, absolutely. So I think this is one of the big trends, if you will, that's happening, where we're starting to see TradFi players coming into crypto. We've seen that in multiple places. We've seen that on the real world asset side, where we have players like Apollo and I guess Hamilton Lane coming in, they're tokenizing and real world asset products. On the flip side, we actually have the Fidelities of the world who are allowing their clients to be on chain, right? And so we're absolutely going to see that, I think, in the next couple of years, maybe 3 years, we're going to start seeing, I think, that convergence of TradFi and DeFi.
You mentioned you're watching Fed rate cuts. Fed cut rates by 25 bips recently. I think they're saying 2 more rate cuts coming this year. I know you got into DeFi during the DeFi summer of 2020. Are we heading towards another DeFi summer?
Yeah, so Jen, 5 years is a long, long time in crypto. And so, I started my previous fund at the beginning of DeFi summer in 2020. And back then, it's just so different from where we are now, right? So back then, I think it was all Ethereum, right? There were no other chains really with DeFi on it. And gas fees were like, I don't know, $50 to $100 per transaction. There was only maybe about 10 or so DeFi protocols, maybe about 10 million locked in. And there were lots of smart contract hacks. The whole space was very, you were rug pulled. Now we fast forward 5 years out. And to answer your question, absolutely, we are now, I think, in the beginning of the next DeFi summer or the DeFi fall, I guess now. It's literally, so now we have about $150 billion on chain, right, in total value locked. Ethereum is still the leader, but now we have a whole bunch of other side chains where a lot of the transaction happens. So with the L2s, you have the gas fees come down significantly. It makes more sense for people to transact. DeFi has become a lot more institutionalized, right? So we have players like us coming in. We're actively managing funds on chain. We're deploying into vaults. And also, I think on the risk side, interestingly enough, the risk management side, we now have tools like Hypernative that allow you to monitor suspicious activity and get out if something's going wrong. So I'm very, very bullish DeFi, right? Very bullish. And I do think that in the next 4 or 5 years, it's going to get even more institutionalized and and you have way more TVL than there's now.
I'm remembering, though, 2021-ish, where we were being promised 3,000% API on certain projects. There was a lot of like quick money in, do it for a couple of days while everyone else comes in, take it out. And it left a bad taste in a lot of people's mouths back then. And I'm wondering, now it feels much more stable. People really understand what DeFi is. It's not a get-rich-quick scheme. It's really just an investment strategy. But I'm just interested in what are the biggest risks you're seeing today still for those who want to invest in DeFi?
Yeah, Sam, so, the stuff that you mentioned where, yeah, you're absolutely correct, right? In 5 years from now, it was the Wild West, yeah. Right? And you were getting the 3,000% returns, and people would go in and out, but people also got rug pulled. That's changed a lot, and I'm just going to give you two interesting examples, right? One is that we're starting to see protocols like, there's a new app called Superform that's launching, in fact, at this conference, superform.xyz. They are trying to bring the next 100 million, 200 million people on chain. And they started off actually as a yield farming app. They aggregated 2,000 different apps. And now what you can do is they've actually tied up with Coinbase, and then you can actually transfer money and then just deposit. So they become like an on-chain wealth manager, right? So we're seeing a lot of that behavior. And in terms of risks, interestingly, I think the risk profile of DeFi has shifted from smart contract hacks and rug pulls to now depeg risks. You have people at one point were worried about Tether depegging from yep. USDC. Now it's more about, is stablecoin number 150 going to maintain its peg against Tether, right? So those are the things that we now worry about, and in some ways it's a good problem to have, right? I think we've come a long way. There's almost 300 billion of stablecoins, and we still have a ways to go, I think, on the risk side, but literally it's night and day compared to 2020.
Sanat, thanks so much for joining us at the desk, and good luck with your panel.
Thank you. Thanks for having me.